my man Paul Winkler, I've been around Paul enough to know that he cautions us not to get too excited about a period of a day or two or 8 or even a couple of weeks regarding market adjustment, but he's here to help us understand what the heck's going on. Paul Winkler joins us on the Matt Murphy Show. Paul, what's going on, man? How are you? Hey, Paul, how are you?
Hey, you got me?
I got you.
Hey, buddy.
What's going on?
A lot is going on. We talked about Bitcoin a couple weeks ago, and that's taking quite a pummeling, isn't it? And, right?
Look, if a business that I'm invested in, or if anything that I'm invested in is taking a pummeling, I still want to know that they're still making something, they're producing something, and you and I talked about that last week. It's like I'm not so sure that's going on, but all right. So let's start here, Paul. I mean, I know you well enough, and you and I have talked on a professional level, and we've talked on a client to a company level as well. So help us understand what's happening right now, and why we should calm down about it all, because I feel like there's a little bit of panic going on. Yeah,
I think that people need to keep in mind is you have a crisis of confidence. You hear people saying that over and over again. Then you have this carry trade talk. They're talking about that. Crisis, and when people lose confidence, what do they need? If I perceive that there's more risk, you're going to have to give me more return when I buy something. So people call it a market sell-off, and I jokingly will say it's a market buy-up, because the people that are willing to take risk and have intestinal fortitude will be buying in these types of opportunities. Not to say that you ought to time the market and try to figure out where it's going to go next. But you look at market downturns like this and say, well, how often does this happen? Well, 5% downturns happen on average since 1953. They happen 3 times per year, 5%, 10% downturns intra-year. So inside of a year, that happens once a year. So it's so normal that it's not even worth paying much attention to. You get a 15% downturn that's every 3 years and a 20% every 6 years. So you look and they go, oh, wow, this is something that is fairly normal. But basically what's been going on is when people lose confidence, they go, okay, I'm going to pay a lower price. And you think about it, when I am buying something for a lower price, but the earnings haven't changed, I am basically building in, or I'm increasing the yield on that investment. So let's say you've got a CD that pays 4%. I'm just going to use that because people get this idea. And 4%, and then all of a sudden you say, I'm not going to pay $100,000 for that $4,000 I'm going to get in interest, 4% of $100,000. I'm only going to pay 50, let's say. Well, I've just increased the yield to 8% when I've done that. So if I've lost confidence, or I'm worried about something, or, maybe the stock market's spooking me a little bit, I will drop that. And what happens is, from a CEO standpoint, I'm going to go, oh, crud, earnings might be lower in the future. Therefore, what we've got to do is we've got to get rid of some expenses, because I can either increase sales, and if the economy's bad, I can't increase sales. I can decrease expenses, though, and I can lay off people and increase my earnings later on. So these market downturns are always temporary. We go through this all the time. And what happens is that not only do the CEOs, the board of directors, people that work for a company, but even government, believe it or not, they want earnings to go back up. So they will eventually, kicking and screaming sometimes, go and change so that you can get earnings to go back up. Because if the earnings don't go back up, then taxes go away. If taxes go away, then government goes away. If government goes away, the FDIC goes away, and everything is built on capital markets. But, you're putting up with market ups and downs. That's just the way things work.
So what triggers it? Is there any one thing, or is it so many factors that it would be difficult to describe? Was it the earnings report that came out last week? Is today a result of how Japan reacted to that, or is there any one specific thing that we can say would cause the bump in the road, so to speak?
Oh, it's so hard to put your finger on it. They try.
If we knew what triggered it, then we would know when it would happen, right?
Well, sort of, but you got to know the news. If you look at, for example, what happened in Japan, you had the carry trade. And that is like, what the heck is that? Well, what happens is people gamble, as they like to do, and they borrow money at low interest rates, and they try to invest in a currency that pays a higher interest rate. You'll have differences in what interest rates countries are borrowing at all around the world. And what they're trying to do is trying to make money on that leverage. Well, what happens is it went the wrong way, and then that gets people into a panic. And then they start to look at AI, and they go, well, is AI going to be everything that it cracks up to be? You know, you had some of these tech stocks. I don't know if you looked at the underlying tech companies that make up so much of people's portfolios right now, but you had some of these tech companies going down 20, 30, 40%. I mean, literally in just a couple of days. And that's something I've been talking about on the radio show a lot, that a lot of American investors are overweighted in index funds that are capitalization weighted, or mutual funds that are overweighted in tech because they thought it would go up forever. And I'm like, no, you can't bet on that. Markets go up and they go down, and stocks particularly. You know, you look back at the tech bubble, 2000 through 2002, you had an 80% decline in the NASDAQ during that period of time, 80%. If you were diversified during that period of time, yeah, you had, short-term downturns, but literally, 2000, you had areas of the market that actually went up. Most people didn't hear about it. 2001, when I started the radio show, you had small cap stocks going up 25, 30%, but a lot of people weren't invested there because they were so tech heavy, because everybody was talking about tech and, what's exciting, the hot trade. And that's where people really get messed up. But to try to figure out what area, what's starting it, where it's going to go, it's all news, and the news is coming in at a frantic pace right now. But you had a big thing, like you mentioned, was unemployment. And all of a sudden, that means maybe the economy's slowing down, because if people aren't employed, they're not buying stuff. And they're not buying stuff, then sales go down. But the other thing that eventually happens is the cost of doing business goes down, and that seeds the recovery of markets, and you don't know when that's going to happen. The average market downturn, historically, since I think it's 1960s, New York Times did a thing on this years ago, it's probably the best article they ever wrote, was the average downturn, you can count it in days on how long it takes to recover. 111 days. Yeah. It doesn't take that long. And I know that you're because I am a client, right? So I know that the clients of yours are probably more calm than the general population. But what do you say to the general population that looks at what's going on, and they start worrying about words like recession? Right. Do we use those types of words too much when things like this happen? Well, in reality, when you look back at recessions, I did this one study one time where I says, what if you invested at the first day that we determined that a recession had actually started, and looked at 1 year later what happened in your investment portfolio? The vast majority of the time, the portfolios were actually at a higher level a year later, even if you started when the recession did. So it's a mistake to think that recession means down stock market. It doesn't. Some of the worst economy that we had literally was 2009, 2010. The economy was not good, yet the stock market went up. Market downturns precede the recession. So if you have a market downturn, by the time you figure out that we're going into a recession, it's like the horse is already out of the barn. So it's futile to try to figure out where the market's going to go next and what the recession is going to do, because it doesn't mean the stock market's going to go down.
This morning, there was a lot of clamoring online about some of the trading platforms being offline or being you're not able to log in. Has any of that reached to you, and do you know of any reason why that would be?
Yeah, well, what happens is people are trying to trade, then they're trying to market time, they're trying to stock pick, they're trying to move their positions around. Recognize that any time, they're clogging it up. Anytime that you make a change in your investment portfolio based on a prediction about the future, where it's going to go, it's going to continue to go down. That's what people are doing, is they go, oh, it went down, I think it's going to continue to go down. It's a basic problem with investor behavior that they complete patterns in their brain. If something goes down, they in their mind believe it will continue to go down, just as if it's going up, they continue to believe it's going to go up in the future as well. They continue that pattern. And what happens when markets go down, they go, oh, I got to protect myself. And they don't recognize that they're selling into a market that is already down. You don't know what it's going to do next. you could sell, and all of a sudden it goes up, and you've missed the upturn. So you got to be right twice with market timing. You got to be right when I get out, and I got to be right when I get in as well. Futile. But that's basically what they did. Is they clogged up the markets. It shuts it down. It doesn't affect me at all because I don't engage in that behavior, and nor do my clients.
Right.
I walked in the office this morning. I says, what's going on, guys? And they said, one phone call. And I was like,
well, no, and that's good. I mean, that's
it. If you educate them, right.
Right. And but a lot of people who haven't taken my advice and called you. They're asking me the question about some of the markets online or some of the trading platforms online. And it's sad that we're in a place where we're mistrustful of why these things happen like this. But there's a lot of mistrust in basic institutions nowadays. I think you can understand that, Paul.
There should be. I mean, you're preaching my gospel there, because basically what I say is you can't trust. You need to understand, at least have a base understanding, because you will always worry and you'll be scared of that which you don't understand. That's why I think it's so critical just to get how stuff works and then recognize, okay, now I know what I'm doing. I know why I'm doing it. I know expenses. I know what to expect. If I've got those 4 things going for me, then I don't end up being pulled in and making mistakes at the wrong time. So, I don't think you ought to trust the investment industry. I seriously, that's my big thing is, remember that one study I think I told you about, the USC and Indiana University, and they said, hey, let's take a look at investment advisors' portfolios. And they were making the same mistakes, with their portfolios that they were their clients, and they were going against the academic research, which just made no sense. But they said, hey, look, if they can't do this, if they're making mistakes with their own money, the advisors, how can we hold them to a fiduciary status where they keep your best interest first, and they can't even keep their own best interest first? One
of our loyal listeners asked me on the super text line, and we've only got about a couple of minutes, but I want to ask you this question because I think it's a pretty good one. Do we use terms like, I think technically we went through a recession when COVID popped. I guess if we're defining it by 2 consecutive quarters of negative growth, I think that's the definition. So if that's the case, do we focus on words and language like that too much when talking about the American economy, in your opinion?
I don't know that you're focusing on it too much, because you're talking about not just stock markets. You're talking more about people's paychecks. Mm-hmm. When I'm going into a recession, I'm worried about, hey, not did my portfolio go up? Will I have a job next week?
Right.
I think that's really what we're focusing on. Is the economic policy in Washington conducive to us having jobs in the future is really what it gets down to.
Right.
So I don't think it's over-focused on.
Yeah, and kind of 2 different subjects, right? When you're talking about the stock market and why the stock market's, they can be interrelated and overlap, but it's a very different thing wondering whether or not you're going to be laid off versus wondering whether or not, your portfolio is going to repair itself in the next 6 months. No, I get that.
Absolutely.
That makes a lot of sense.
Absolutely. Yeah.
Paul, great stuff.
Absolutely.
Great stuff as always. You know how much we love you on the show, and thank you so much for everything you do.
Well, you too, Matt. Thanks a lot,
take care. There's Paul Winkler. You hear him weekends from 3 until 6 on Saturdays. And then, of course, he's a great friend. I am proud to endorse Paul Winkler and the way he does his business. And obviously, I'm a client of his as well. And I think he is a very, very smart man.